Hi there, everybody. This is Samantha from the law offices of Samantha Wolfe, and we're located at 20 East 6th Street, Suite 206 in Waynesboro, PA. And you can reach us at 717-655-2676. And this afternoon, we're going to do our monthly virtual seminar. And today's seminar is on tax updates. So I'm going to go over some of the proposed tax updates and what we're likely to see in the coming months. So I'm excited to do the topic. So let me share my screen here so we can all follow along. Okay. So this is just a picture of the outside of our office, and you can reach us at 717-655-2676. And we do our initial consultation. So we welcome you to call, and we'd be happy to meet with you. Okay, so today we're talking about tax updates, and we're calling this session Keep Your Seatbelts Fastened Until We Reach a Complete Stop. And the reason why we picked this title is because there for a while we weren't sure what was going to be happening with who was going to be president. And we wanted to wait till the end of the month because we figured things would be a little bit more settled and we have a little bit more idea as to what would be happening. But please know that what I did when I compiled this information is I looked to see what President Biden's agenda was, or his tax agenda, when he was campaigning, as well as what's been coming out in the first few weeks of his administration. So that being said, I do feel like we're on a little bit like a roller coaster. You know, there's kind of a plan out there, but there's lots of twists and turns. Things may go fast, things may go slow. You just never know. So I'm going to break this session up into a couple of different topics. So we're going to focus on the COVID-19 spending plan that he released on January 14th. And then we're going to move on to what he included in his tax agenda when he was campaigning. We're going to talk a little bit about that, what that means for income tax purposes, as well as for estate and gift tax purposes. And then we're going to close with talking about how this affects your planning and what you should do or consider different planning techniques. So with that being said, let's fasten our seatbelts and let's start talking about tax updates. So I love talking about tax updates. It's interesting to me to see what's happening, to kind of see where we've been, where we're headed. So today we want to focus on how this affects you. So let's talk a little bit about the COVID tax updates first. So the first thing is that we have the COVID-19 spending plan. This was released January 14th, 2021. And this was a one-time relief package that President Biden is proposing for Congress to pass, with passage hopeful in the next 2 months. It is a $1.9 trillion package designed to sustain families until vaccines are widely distributed. $250 billion bailout to state and local governments. And another component in there is the $15 an hour minimum wage increase. What's interesting to me about that is that the federal minimum wage has been set at $7.25 since 2009. That was the last time it was increased. And then each state can set their own minimum wage. So for example, some states out west, like Washington and Oregon, they have a higher state minimum wage than $7.25. And they actually, even if the federal minimum wage would increase to $15 an hour, their hourly minimum wage for that state is still higher than the $15. But here in Pennsylvania, Pennsylvania matches the federal minimum wage amount. So right now in Pennsylvania, the minimum wage is $7.25. Part of the proposal would eliminate the tip wage that's paid in most bars and restaurants. So if you've been a server or are a server now, that may affect how your tips are calculated. Interestingly, what's not mentioned in the COVID-19 spending plan is there's no mention of student loan forgiveness. That got a lot of traction during the campaign. President Biden at the time had said that he was going to be a proponent of student loan forgiveness. We didn't see that in the COVID-19 spending plan that was released on January 14th. Doesn't mean it won't show up if further tax bill is introduced. But as of right now, there is no student loan forgiveness in the current COVID spending plan. There are, however, the proposal for direct payments of $1,400 to most Americans. So when you combine that with a total relief of the $600 we received in December, that would be $2,000 that Americans have received as a result of direct payments from the government. The other thing that Biden is proposing is increasing federal per week unemployment benefit to $400 and extending it through the end of September. And then the last thing on the slide talks about extending the eviction and foreclosures moratorium until the end of September 2021. We've seen the moratorium on evictions and foreclosures continue to be moved out. We saw it at first, it was July 1, then it kind of pushed out a little bit farther. So it's just continued to have been pushed. So this spending plan would actually keep that moratorium in place until September of 2021. The other thing that is involved in the COVID spending plan is talking about the testing. So we would have $50 billion towards COVID testing. $20 billion would be towards a national vaccine program in partnership with the states. And then we'd also have a child tax credit, which would be fully refundable for the year and would increase the credit to $3,000 per child. Now, this is just the initial spending plan. There is the thought that there would be a second bill. And when I was reading all the research on this, it was talking about how that's expected to be presented in February, and that will tackle long-term goals. So when we're talking about Biden's overall tax plan, maybe we'll see something as early as February, the end of February, as far as what he's proposing for that. We'll just have to wait and see how that goes. So that went over the COVID-19 spending plan. Now what I want to do is I want to look at the general tax updates, income tax updates that Biden had proposed as part of his tax agenda when he was campaigning. And we're still seeing the same rhetoric coming out of the first couple of weeks of his administration. So that's what all of this material is based on. When it's actually proposed, then there'll be some back and forth debate about what gets included, what doesn't. And then we kind of end up with a final bill. So these are just what he had proposed as part of his campaign. So the overview is that his tax plan would raise tax revenue by $3.3 trillion over the next 10 years. That would be on a conventional basis. It would collect about $2.8 trillion over the next decade based on macroeconomic effects. According to Tax Foundation's general equilibrium model, the tax plan would reduce the gross domestic product by 1.62% over the long term. And when I was doing research, all of the information that I gathered was from the Tax Foundation and from Clippinger, which is a renowned tax organization that produces material so that people can keep up to date on what different politicians and different campaigns are proposing. So that's where this information is coming from. So the first thing that we would tackle is the payroll tax changes. So under Biden's tax agenda, there would be an imposition of 12.4% Social Security payroll tax on income earned above $400,000. That would be evenly split between the employers and employees. Interestingly, that would create a donut hole in the current Social Security payroll tax because wages between $137,000, which is the current wage cap, and $400,000 would not be taxed. So it does create a donut hole in there. And you're going to see the number 400,000 repeatedly through this material. And the reason is because Biden promised not to raise taxes for anyone making less than 400,000. So the target number is anybody who earns adjusted gross income above that. And we'll talk about, does his tax agenda actually do that? And if not, where would it actually subject people who would earn less than that to more tax? We're going to talk about that too. During the Democratic primaries, other candidates did push for a wealth tax. President Biden didn't push for that, but a lot of his tax changes are going to affect individuals over a certain income threshold, and that income threshold is $400,000. So more income tax changes that is proposed was that he was not a proponent of Medicare for all. Instead, what he favors is keeping and improving the Obamacare. So there are 4 ways that he is planning to do that. The first is eliminating the income-based cap on premium tax credits so that any family who purchases insurance through the healthcare insurance exchange can claim that credit. He does want to increase that credit. Right now, it's based on a silver level plan, and there's kind of different levels if you're on the health insurance exchange. So the top of the line is the gold level plan. That's where you get the most coverage, but typically that plan is the most expensive. So the credit that right now is just at the silver level amount would increase it so that it would be on the cost of a gold level health plan. Another way that he wants to improve Obamacare is to create a tax penalty on pharmaceutical companies that increase drug costs by more than the rate of inflation. And that would also include taking away their deductions for advertising expenses. So all of this is, again, targeting pharmaceutical companies in hopes that they keep the cost of their drugs lower and more reasonable for individuals and participants of the plan. Lastly, he wants to eliminate the tax incentive for pharmaceutical companies to move production overseas. So again, the goal is to bring the jobs back here to the United States. And so by eliminating tax incentives that companies would have, the hope is that they'll stay here in the United States and produce the drugs and the needed product here. Now, as it relates to individuals' income tax and the effect that it has on us as individuals, this slide is devoted to that. So, interestingly, the top income tax bracket right now is 35%. 37%, I'm sorry. Trump lowered it from 39.6 to 37%. And that would be for anybody who has adjusted gross income over the 400,000. Biden is wanting to bump that back up to the 39.6. So it would be an increase in the highest tax bracket. Again, that would be for individuals who have adjusted gross income over that 400,000. So again, targeting that 400,000 as the adjusted gross income. The next 2 points on here I have bolded and underlined, and that's because I think that these are actually the two most important concepts to come out of all of this material. And I think it's the two concepts that would have the most impact on you and I as taxpayers. And the first is that the long-term capital gains and qualified dividends would be taxed at ordinary tax rates. And what's interesting about that is right now it's 15 or 20%. If we're taxed at ordinary income tax rates, most likely the minimum, is going to be 15, but you could get 25%, all the way up to 39.6% would then become the highest. And that would be, you would be taxed at ordinary income at 39.6% on income above 1 million. Now, the reason I have this in here is that there were two different proposals that came out. One was that this taxation of long-term capital gains at ordinary income tax rates would only affect those who had income above 1 million. So we'll see how that plays out. It could be that it's for all of us, but it could be it's just for those high earners as well when it actually gets passed. The other thing is that it eliminates the stepped up basis for capital gains taxation for inherited capital assets. This single point is the one that I think has the most impact on you and I. So Tammy and I, when we work on estates here in our office, if somebody has real estate or stock, when they pass away, automatically there's a stepped up basis in those assets. And so it typically means lower income tax rates if those individuals liquidate that asset at that time. So we're going to talk a little bit more in detail about that. I'm going to actually show you some examples on how impactful this certain tax proposal is for you and I. The other thing it would do is limit like-kind exchanges by real estate investors. So right now, if you sell a piece of real estate and then you take that money and invest it in another piece of real estate within 180 days, typically you're able to defer the tax. And so that would be a like-kind exchange. And so under Biden's tax proposal, there would be a limit to that type of deferral. And then the last thing on the slide would be capping the tax benefit of itemized deductions to 28% of the value for those that earn 400,000 or more. So taxpayers earning above that income threshold with tax rates higher than 28% would face limited itemized deductions. So, and we saw less itemized deductions being taken under Trump's tax plan, and that was just because the standard deduction was so much higher that most people weren't able to itemize. So under Biden's plan, what this would do is it would phase out itemized deductions, usually for people over 400,000. Another thing that Biden's tax plan does is it would phase out the Section 199A qualified business income deduction for filers with income over that 400,000. And that Section 199A was something that was passed during Trump's tax plan, and that gave a 20% deduction for businesses. So they kind of got that deduction right off the top before they had to claim the income. And so there would be phase outs of that if you earned over 400,000. The next point deals with the child care independent tax credit. And so this again is talking about for a maximum, it was a maximum of 3,000 qualified expenses, and that would be increased to 8,000 or 16,000 for multiple dependents. It would increase the maximum reimbursement rate from 35% to 50%. There is a thought that there would be a temporary increase in the child tax credit to $3,000 per child for children ages 6 to 17, and then $3,600 for children under 6. And that would be refundable and in advance during the pandemic. So we'll see if that comes into play too. Now, we're talking about forgiveness of student loans. Biden was a proponent of that when he was campaigning. He was a proponent of forgiving up to $10,000 per borrower, and then that forgiven amount would be excluded from income tax. Because typically, when you are forgiven a loan, you then have to include it in your income. So it would be forgiving the $10,000 per borrower. Now, other Democrats are requesting a $50,000 per borrower forgiveness amount. So we'll see as that's negotiated in Congress, assuming that makes the bill, and how that plays out. There would be a payment pause on the amount of student loans during the pandemic, as well as an interest waiver during the pandemic. Another part of it would be expanding the work opportunity credit to include military spouses. And then the next one is talking a little bit more about that child tax credit, which we had covered in the previous slide. Biden is proposing to reestablish the first-time homebuyers tax credit, which was originally created during the housing market decline. And so this would come back into play, and it would provide up to $15,000 for first-time homebuyers. There would be a new renter's tax credit that would reduce rent and utility cost 30% for low-income individuals. And there would be a support behind expanding the low-income housing tax credit, and that would be providing incentives for construction or rehabilitation of affordable housing for low-income tenants. The next one I have bolded because I think it's very impactful to clients that we deal with, and that would be increasing the tax benefits for elderly who pay for long-term care insurance with their retirement savings. I would hope that if they do implement something like this, they expand it to not just traditional long-term care insurance, but also to life insurance with a long-term care rider, or any type of investment product where there's a long-term care component to it, so that way clients who don't just use traditional long-term care insurance, but could use life insurance with a long-term care rider would also get that same tax benefit if they use their retirement savings to pay for that. So we're always looking at how do you pay for long-term care, and we do virtual seminars on Medicaid and how to qualify for that, how to use trust. But this would be another interesting way that you could help pay for your long-term care, and that would be using retirement funds to do that. The proposal would also allow low-wage workers over 65 to claim the earned income tax credit. Currently, if you're over 65, you cannot claim that, so it would be an expansion of that credit. And then the last bullet point here is a new $5,000 tax credit for an informal caregiver, which would be a family member providing care or another loved one providing care for their elderly loved one. And this would allow caregivers also to catch up contributions to retirement accounts. So again, if mom and dad had me be their caregiver and they were paying me a certain amount, it would allow me a $5,000 tax credit. In addition, if that was how I was earning my income, it would allow me to catch up if I had made any contributions in the years prior, if I made it to my retirement account. So again, these are all great things. We're seeing more and more focused legislation for long-term care. And so I think that's always a good thing. So it gives us more options, more tools in our toolbox when we're planning for clients, different things they can use. So I think those are both good things that would come out of the tax agenda. There would be an increased tax credit for employers, including small businesses that hire a person with a disability, and that would be $5,000 the first year and $2,500 if the disabled worker completes the second year of employment. The next bullet point is bolded as well because it would expand access to ABLE accounts. So ABLE accounts are an account that set up an institution that allows an individual who's currently qualified for benefits to continue to receive those benefits. In addition, there would be that ABLE account there, and they could use the funds there as well. So I think that would be great if we can expand that account. Sometimes people don't have enough to set up a supplemental needs trust, but they do have enough funds that they could use an ABLE account. And then lastly, the tax agenda, there was a proposal for a climate change plan, and that would be pushing tax breaks for energy efficiency in home and other buildings and increasing tax incentives for carbon capture, use, and storage, and supporting a carbon tax. So those would all be tax ways that would fall into a climate change plan. So those dealt with individual income tax changes that we saw in the tax proposal. The next part of it would be income tax, but related to the corporate side of things. So first thing to know is that in 2017, when Trump's tax plan came in, it dropped the corporate tax from 35% to 21%. And so Biden is proposing to increase the corporate tax rate from that 21% that Trump had lowered it to, increasing it to 28%. So it wouldn't go back up to its 35%. It would just go up to 28%. And that's what Biden is proposing in his tax plan. There would also be a minimum tax on corporations with book profits of 100 million or higher. So sometimes when you're doing your tax returns, on the return it's going to show a loss or that there wasn't any profit. And what this is saying is that if there's book profits of 100 million or more, then there might be a minimum tax that's automatically on those businesses, regardless of what the tax return shows. And it was shown in the tax proposal to be 15% minimum tax, still allowed for net operating losses and foreign tax credits, but it would be that minimum 15% tax. It would double the rate on global intangible low tax income earned by foreign subsidiaries of U.S. firms from 10.5% to 21%. It would support a clawback provision to force companies to return public investments and tax benefits when they eliminate jobs in the U.S. and send them overseas. It would implement a 10% surtax on businesses that avoid U.S. taxes by sending any jobs or manufacturing that they might have overseas and then selling those goods back to us here in the United States. It would support a new manufacturing community tax credit that would promote revitalizing, renovating, and modernizing existing facilities. And any deductions for expenses associated with sending jobs overseas would no longer be able to be taken. They would be eliminated. And then there would be certain tax credits to small businesses for adopting workplace retirement savings plans. So these are all things related to corporations or businesses that I wanted to make sure to highlight. So that covers all of the income tax changes. Now, I want to make sure to remind everybody that none of these have actually been implemented or enacted into law. What would happen is that it would have to go through the House, the Senate, and then President Biden would sign it. But again, what I was looking at was what were his campaign policies, or what did he say when he was campaigning as to what he would do regarding the income tax, and then what we've seen coming out the first couple of weeks of his administration. So you need to keep an eye on that just to see how things are coming, and we will certainly make sure to update everybody once we hear things that are coming through the actual Congress or the pipeline as far as tax changes that President Biden is making. So the next component of tax changes is the gift and estate tax. So we talked about income tax. Gift and estate tax is a federal tax, and it's on somebody's right to transfer assets. It's all about when does the transfer occur. So gift tax is if something is transferred during life. Estate tax is if something is transferred at death or as a result of somebody's death. So right now, every individual has over 11.7 million. And if you have a spouse, you can couple those together. They call that porting. You can port those, which means that you can double that. So you would have, $23 million that you'd be able to pass at your death without any tax. And Obama had bumped it to 5 million. Trump had increased it to 11.7. We've never seen it be reduced, but President Biden had proposed to reduce it to 3.5 million and then increasing the tax rate from 40% to 45%. So it would be a 5% increase on that tax. Now, just remember that even if it drops to 3.5, husband and wife would actually have 7 million. So there'd be no tax as long as it didn't go over the $7 million. Well, I love to think about when I'm reading candidates' tax proposals, I love to think about what's going to be the most impactful to my clients. And so when I was reading Biden's tax agenda and his tax plans, the thing that struck me was that the loss of the stepped up basis and the changing of capital gains rates to ordinary income tax rate, those would be the two most impactful changes. And the biggest one would be the loss of the stepped up basis. And so in my mind, I was thinking, yeah, like that's the most impactful change. And I hadn't, what I thought had not perceived anybody talking about that in the news. And so I just, when I was putting together the presentation, I looked it up just to make sure, what was coming out. And wouldn't you know that Forbes magazine had published an article on November 2nd, 2020. The title is Biden's Tax Increase on Debt That No One is Talking About. And I encourage you to look up this article because it's going to go in detail about what I'm going to be talking about here in the next couple of slides. I'm going to hit the high points, but it's this fact that there are these proposed tax policies that Biden is proposing that would really impact you and I drastically. And the way it would do that are two different ways. The first is that it really changes the interplay between estate and income taxes. They've always interacted to a certain extent. So we know one is the estate tax is a tax on somebody's right to transfer assets when they die. And then income tax is, of course, when you have any type of accession to wealth or any increase in your wealth, that's going to be the income tax. And so there's always been some sort of interplay between them. But the loss of the stepped up basis really does change that interplay. And so we're going to talk about that. What's important to know about this is that it would increase income taxes at somebody's death for everybody, not just for those who have over 400,000. This would be a change that would affect no matter how much you make, it's going to affect everybody across the board. And so I think this is really important for everybody to know. Then secondly, it does increase the long-term capital gains and qualified dividends at ordinary income tax rates, which means that it would take long-term capital gains right now, the maximum is 20%. It would increase that to 39.6% if you exceeded 1 million. So we're not sure if that's just going to be if the capital gains exceeds 1 million or if that's going to be for everybody. It matches your personal income tax for ordinary income purposes. So we'll see. But even still, if you're talking about how does that impact when somebody passes away, it could have a huge impact because you won't get the stepped up basis, which means you'll have more that you're recognizing. And we'll go over this in detail. And when you're recognizing that gain, when you're paying tax on it, it's going to be at a higher rate. So this is very impactful. And again, it's all brought on by somebody's death, but it really has huge income tax ramifications. And I'm not seeing a lot of coverage about it. And so I wanted to make sure everybody knew what was going on. So with that being said, with that background, let's talk a little bit more specifics about that. I'm going to use my parents as an example. So if my mom and dad came in today and we're talking about planning and what they wanted to do, a lot of what we do is asset protection planning and protecting assets against long-term care costs. And so we may be meeting with a client and they may say, we really want to avoid the tax if at all possible. And we may say, okay, well, you may want to avoid tax, but what you don't want to do is avoid one tax and then get hit with another tax, and that other tax is actually higher, or you're going to pay more tax on it. And the best example I could give is that we have a lot of families that say, well, I don't want to have to pay Pennsylvania inheritance tax. I don't want my kids to have to pay that. Pennsylvania has a tax that's on the recipients. So if my parents pass away, inheritance tax is actually on me, where the estate tax is on them. So the inheritance tax is on my right to receive the asset at somebody's death. And the rate of tax depends on the relationship to the person who died. So if it is a child, the child pays at 4.5%, a sibling pays at 12%, and then everybody else, for example, my nieces and nephews, would pay at 15%. And so it's all about your relationship to the decedent. And so somebody might say, well, I don't want them to have to pay inheritance tax. And what I always say is, okay, I get that. You don't want them to pay the 4.5%, but it might actually be better for them to pay that 4.5% because they're paying it because mom and dad left it in their estate. So they're paying on their right to receive. But because they left it in mom and dad's estate, there's a stepped up basis in it. And that means that if they then sell the property, there's less income tax that they'll have to pay. And that's really a big deal because the income tax rate right now for capital gains is 15%. Now, if it increases, it's even a bigger savings, or an even bigger impact. So you pay the 4.5, but then you avoid the 15% or the 20%, or if they change it to 39.6%. So sometimes families will ultimately decide to pay the inheritance tax because as part of that process, it reduces or eliminates income tax that they would have to pay at a higher rate. So with the changes that Biden is proposing, instead of getting that stepped up basis like we're talking about, what would happen if there'd be a carryover basis? So best example I could give you is if my parents, for example, had an account with stock in it, and let's say that it's worth 200,000, but when they purchased the stock, it was only purchased for 10,000. So that's their basis in the stock. Okay. If they would die today, I would get a stepped up basis, which means my basis in the stock would be 200,000. But if Biden's proposal passes, I would not get a stepped up basis of 200,000. Instead, I'd get the $10,000 basis. I'm carrying it from my parents. It's being carried over to me. So that becomes my basis, which means that I now have, if I would sell it, $190,000 of gain that I would have to pay income tax on. Now, again, right now, that would be either 15 or 20% for long-term capital gains. If that changes and it's subject to ordinary income tax rates, that could be 25%, that could be 39.6%. So it's a huge deal for our families that we're planning for. This loss of the stepped up basis. The other thing that's interesting to me is, when we're talking about this in my example, I'm talking about stocks. It is easier to track the basis of stocks because normally a stock certificate or there's some sort of record, what you purchased it for. This is going to be a big deal for real estate. So think about this. We have a lot of family farms in our area, and they've been passed down through the family. So either it's a low basis, meaning, maybe they purchased it for 20,000, or it could be that the deed even indicated that it was a gift, which means that you might just say $1. It was transferred for $1. So whatever it says on there, most likely it's not what the fair market value is now. And what would happen is if you cannot prove the basis, then you're stuck with a zero basis. So if either the deed says $1, or if, let's say, you purchase it for 10, you purchase the land, just the raw land for 10,000, and then you built a house or a farm on it or some other structure, and you're contributing money, that would actually increase the basis. But if you can't provide receipts or records to show that, then you're still stuck with the zero basis. They're not going to just grant you a stepped up basis anymore. So it used to be that for our purposes as attorneys, accountants, for the professionals who were trying to make sure that we're doing all the documentation, stepped up basis was really nice because we got a clean slate. And so we knew if you're disclosing it on the tax return, it's whatever the fair market value is on the date of death, that becomes the basis. And so for families that has been passed down through generation to generation, you'd get a stepped up basis every time somebody died. And so it's easier to determine what taxes are being paid, if it's sold for income tax purposes and capital gains have to be paid. I cannot imagine having to track this. And what I find interesting is when Obama was president, he had a similar proposal. This has been around for a while. They've thought about doing this, but at the time, back in, I think it was 2013, when I initially was reading about it, they ultimately decided not to do it because they realized what a mess this would make for accountants and attorneys trying to track all of this and how much bookkeeping would be required. So it actually got nixed from the tax plan back then. So I don't know if we're going to see something similar with this, but if it stays in, this is huge. I can't even describe how big of a deal this is. And it would, be a tax that maybe people aren't anticipating because normally they'd get a stepped up basis. So this is a big deal. And it's an even bigger deal for us in Pennsylvania. Okay. So let me give you an example of why it's an even bigger deal. So I'm going to use my parents again, and rather than stock, we're going to talk about property. Okay. So let's just say their house is worth approximately $300,000 if they were to sell it. Okay. But let's say they purchased it for $150,000. That's their basis. Okay. It's appreciated in value through all these years, and now it's worth $300,000. If they had passed away in 2020, okay, what would happen is my sisters and I have three sisters, we would pay $13,500 in Pennsylvania inheritance tax. Okay, that would be a rate of 4.5% on the $300,000 value. That would be $13,500. So it would be $36,000 if you're a sibling and paying at 12%. It would be $45,000 if you're a niece or nephew and you're paying at 15%. But we pay the $13,500 for Pennsylvania inheritance tax purposes, but for federal tax purposes, we'd get a stepped up basis. So my sisters and I, our basis in the property would be $300,000. So if we sold it for $300,000 and our basis was $300,000, we've had zero gain that we had to recognize. And that gain in 2020 would have been 15 or 20%, depending on our tax rates. So if our parents had died in 2020 and we had received the property, our tax that we're paying is $13,500, and that would be Pennsylvania inheritance tax, and that would be all the tax that would have been due at death. Okay, so that would be under the Trump tax rules and under the Pennsylvania inheritance tax rules. Okay. And what it would look like is, let's say my mom and dad do have a similar plan to this. Let's say that we had transferred the house in trust to protect it for mom and dad's long-term care costs. And what we would do is in the trust, you'll see it's underlined and bolded. Mom and dad would retain the power to add and remove beneficiaries. Because they retain that power in the trust, it's not a completed gift. So we would all get a stepped up basis. We pay the 4.5 on the $300,000 value, but then we get a stepped up basis for federal income tax purposes. Okay, and we'd get it in trust in this case. Now let's look at what would happen if Biden's plan passes. Let's say it passes in 2021. And what would happen for Pennsylvania purposes, we'd still pay the $13,500, but we'd get no stepped up basis. So what that means is that rather than getting the $300,000 value, you would only get $150,000. So if we sold it, it would be sold for $300,000. Our basis is $150,000. We'd have $150,000 that would be taxed at capital gains rates. And if it's matching with the ordinary tax rate, let's just use 25%, then it's going to be $37,500 worth of capital gains. Now, because this was mom and dad's residence and none of us had it as our primary residence, we wouldn't be able to claim the 121 exclusion on this. So this would be taxed to us. So that means that we would have the $13,500 plus we'd have the $37,500. So we would pay a total of $51,000 of tax. So it would be an additional $37,500. And this is, again, it doesn't just apply to people who have adjusted gross income over $400,000. So under Biden's tax proposal, when he said he's not increasing income tax for anybody that makes less than $400,000, it's true that he's not increasing it under the income tax rates, but what's happening is it still is increasing the tax, not increasing the tax rates, but it's increasing the amount of tax that's going to be paid. It's just being triggered through a state and gift tax, because again, it's all transfers that are happening at death. That's why when I say there's an interplay between estate and gift and income taxes, that's what the interplay is, because up until now we've gotten a stepped up basis. So the interplay has been one way. If this change goes through, it's really shifting it completely. So there would be huge income tax ramifications as a result of that. So again, it's technically because of estate tax reasons, but it will increase people's income taxes no matter what they earn, what their adjusted gross income is. It would be an additional $37,500 worth of tax. And that's combining Pennsylvania with the federal. Okay. If you are in a state that doesn't have an inheritance tax, then you're just looking at the $37,500. So when we're talking with clients, this might have a huge impact on them. So I always like to think of the positive. So what is the positive in all of this? We're talking about all of the negative and how we may have to end up paying more tax and how you might not realize it and how it might be at death, all of those doom and gloom things. So let's talk about something happy. So I have a nice bright sunshine there. So what's the positive of all of this? So for years, when we met with husband and wife, if we take my parents, for example, if I met with my mom and dad and they said we want to avoid tax, Pennsylvania inheritance tax, I would always say, okay, we can avoid the tax, But if there's even a slightest chance that any of these kids are going to want to sell it, you may want to pay the inheritance tax so that you don't have to pay as much income tax when it's sold. And so most clients that I met with were like, okay, even if we use a trust, we're going to do it so that it's still subject to inheritance tax. Well, here's the thing. We don't have that stepped up basis that we need to get anymore. So in Pennsylvania, if we have family farms, or even if it's just real estate, a house, and the plan is that it's going to stay in the family, that nobody's selling it, well, there's no benefit for us to get the stepped up basis if there isn't a stepped up basis anymore. So what that means is that if I have a client that comes in and says, I want to avoid the Pennsylvania inheritance tax, I can do that for them now and not make it so that they're subject to another tax. Okay. So we can avoid inheritance tax now. And how we would do that is either mom and dad would transfer it, either in trust or outright, and they have to survive that transfer by 1 year. And then if that happens, then there would be no Pennsylvania inheritance tax. Now, again, it used to be that we didn't want to do that because we wouldn't get the stepped up basis, but we're not going to get that anyway under Biden's tax proposal. So there'd still be no stepped up basis, but at least we've avoided the Pennsylvania inheritance tax. So in this case, the Pennsylvania inheritance tax is $13,500. By gifting it and surviving it by 1 year, then we've eliminated that $13,500 worth of taxes. If it's sold, it would still be subject to the $37,500. But if it's never sold, then in essence, what we've done is we've eliminated all tax. So again, it used to be that you still want to pay the inheritance tax to get the stepped up basis, because if there was even the slightest chance that somebody would sell it. So now what we can do is we can say, do we think the kids are going to sell it? And if the answer to that is no, it's unlikely the kids are going to sell it, somebody's going to hang on to it, then the benefit of that is that we can avoid 100% of the tax. So this is very exciting for Pennsylvania residents. You're not going to see an impact in other states that don't have an inheritance tax like this. In Pennsylvania, that's where you're really going to see the savings. So we go from seeing $13,500 as a minimum. We now go from that to no tax at all. So this is great news. I'm glad that there's a positive in all of this, because when we're talking about taxes, sometimes it can get a little negative. So all that to say, when we're doing planning now, all it is that instead of my parents having the ability to add and remove beneficiaries, they're not going to have that. So when they transfer assets into this trust, it's a completed gift. And if they survive 1 year after that gift, I just need one of them to survive, then there's no inheritance tax. And if we never sell that residence, then we'll never have any tax that's due at all. Okay. So we still use trust because it would protect mom and dad. So they may not want to deed it over to us, because then technically we could evict them, or, then it's subject to our creditors. So we're still using trust to do it. It's just that our trusts are going to look a little bit different. And again, if they survive it by 1 year, then there's no tax at all. If they survive it by 1 year, we don't even have to disclose it on the inheritance tax return, because it would be considered my sisters and I in trust. So this is really exciting news. Now, I don't know, when people ask how likely is this to happen, again, I still think there's a lot of problems with trying to track the basis, especially with real estate. So I'm not sure how likely this is, but what's interesting is that it was in Obama's plan in 2013. It was in all of the Democrat candidates' plan for election this year during the campaign cycle. So I think that it is something that allows them to generate tax money without actually having to increase taxes, income tax rates. So again, when Biden promised he's not increasing the income tax brackets for anyone below 400,000, that is still true. You may have to pay more tax because of some of the estate tax changes he's proposing. So it allows them to generate more money without necessarily having to take money. Again, because if you never sell the property, you don't have to worry about it. So their thought is, well, you're already selling the property, you'd have the money to pay the tax. So this is a way for them to generate money without you feeling it as much in your pocket. In our case here in Pennsylvania, like I said, it does shift the strategy of planning a little bit, and it gives us some great planning opportunities. So it makes me excited about that possibility. The solution also works for non-real estate assets. When we're talking about stocks, you can gift outright or in trust. Now, we still recommend in trust, and that's just for all of those creditor protections to make sure we're protecting mom and dad, that kids can't do something with those assets until their death, and just protecting against divorce, car accidents, all of that. So we want to make sure, and then making it so it's not subject to inheritance tax if one of those kids would predecease. So if it's held in trust, like we just showed on there, then there wouldn't be inheritance tax if one of the children predeceased. Now, another example would be with stocks. So I do have a client who has about $5 million in a brokerage account and it's invested very heavily in stocks. And same thing, he can gift those assets to his daughters, because what would happen is we weren't advising him to gift it because we wanted him to get the stepped up basis. So he said, well, can I avoid inheritance tax? And my answer was yes, but you may not want to, because they'll get a stepped up basis, which then means it would be a great time for them to liquidate that stock at death, because then there'd be no capital gains tax on that. Well, now that strategy changes a little bit, because yes, we can avoid inheritance tax. And if those kids weren't planning to sell those stocks, then it might be worth transferring them, surviving a year, and then there's no tax at all. Because you only trigger the capital gains tax if you're actually going to be selling the property. So again, there would be no tax if you gifted it and they were going to hang on to it. So I like to be able to provide a positive planning solution. That would be something that, we could help families do. Okay, so I wanted to end it on a positive note. So thank you so much for watching and listening. If anybody has any questions about this material, you're welcome to email or call. I'd be happy to chat with you about it. I also wanted to remind everybody that we're trying to hold monthly virtual seminars. So our next one is on February 15th, 2021 at 12. We try to do them over the lunchtime hour. Because it's Valentine's Day around then, we're going to do how to protect your honey. And you can register for that by calling us at 717-655-2676, or you can email Amy at her email address listed there on screen. What we're going to do is, after the seminar, we're going to be emailing all of our participants a link to the survey so that we can get feedback. I already know that based on the feedback, that we're going to do some new seminars in the spring dealing with particularly farm succession planning and rental real estate and how to handle that. So any suggestions you have, I really do welcome that. And then the last thing I wanted to mention is we're getting our next newsletter ready. And so we'll be sending that out to our clients as well. And it has some tips from our tax experts. So we reached out to some accountants here in the area to ask about budgeting and how important that is. And then I drafted a little blog or a little essay there that you can read too about some legal topics. So we're really looking forward to getting that out, and we should be able to do that in February. So you'll be receiving that in the mail. You're also welcome to ask for it electronically by just email or call Amy, and she can get that to you. We are going to post the virtual seminar on our Facebook page, as well as we have a YouTube channel. So if you haven't subscribed yet to our YouTube channel, we encourage you to do that. Then you'll get notification anytime we post any additional videos or content. You'll get a notification. You can check that out. So I really appreciate everybody being on the call. Thank you so much for doing that. Everybody take care and have a great evening.